Happy Saturday, folks. It's time for the top 20 high-yield ETFs of the week list. My name is Max. My station's name is The Covered Caller. Thank you so much for being here this morning. You got a good video plan today. Do you think your favorite fund's going to make the list? I know that mine did not make it this week. My second favorite made it, though. Stick around. We'll get right in the middle of it. All right, every week we do this Maxfactor top 20 high list or top 20 high yield ETFs of the week list. Now, this list is compiled with my Maxfactor. My Maxfactor is a proprietary formula that I think works better than total return and better than traditional finance measures or traditional finance metrics for measuring ETF performance. These high yield ETFs have different qualities. And I think that the total return and some of the other conventional metrics are not as helpful as my metric. So that's why I embedded the Maxfactor. So let's go see if your favorite fund's on it. Number 20, SVOL. Well, now that's a surprise. SVOL, I don't think has ever been on this list since I started doing this in about 6 months. Now that's, SVOL used to be one of a fan favorite out there, but lately, not so much, but I guess they've kind of kicked it into gear, paying an 18% yield. Their NAV's up 4%, so you're getting yield plus NAV up on the quarter. And very low volatility, 12 is similar to the SPY, so not super risky. Let's see who's next. Number 19, blocks. Okay, when I said my second favorite fund is on the list, this is kind of what I was referring to. And this one made the list, and I'm happy to see that. It dropped a little bit from where it was last week. I think last week it was like 7 or 8. However, this is heavily influenced by Bitcoin and decentralized finance, and that's kind of been in the dumps lately. I just checked. Bitcoin right now is trading at 112,000 Saturday at noon. So hopefully by the time the market opens back up, maybe it'll be back to 115, 120. We'll see. But I know that would certainly help blocks. All right, number 18 is IWMW. This is based on the IWM, which is the Russell. This is yielding a stout 22%, and it almost made 4% NAV return, positive NAV return this quarter. Remember, the NAV return doesn't factor in the yield. You have to separate them to get a real idea of how these do. All right, number 17, K Gold from Curve. Howard Chan has been on my channel, and he was talking about this fund last time he was on the channel, and I'm very interested in it. I haven't got it yet, but I'm planning on getting it. So this baby's yielding 9.2%, but its NAV is up 20% this quarter. That's insane. Like I say, because that doesn't include the yield, so your total return's about 30%. Total return equals yield plus NAV return. And it actually equals yield plus yearly NAV return. This is just quarterly NAV return. If it stays on this pace, it would be 80% for a year. And this is annual yield. So actually this thing's making about 89, 90% at this pace right now. So that's pretty good. Now this is pretty volatile though, especially for a gold stock. It's about twice as volatile as the overall market. So it may be kind of a bumpy ride getting there. All right, number 16, SVOL. We've already talked about SVOL. SLVO. This is a silver-based fund yielding 17.5. 1 year total return of 26. That's really good. The NAV's up 8% just this quarter by itself. That's excellent. And, it has less volatility than K Gold did. K Gold has about a 23 vol. This one has a 17 vol. Meaning K Gold's about 30%. I did the math real quick in my head, about 30% more volatile than SLVO, at least over the past quarter. Okay. Here we have FEPI at number 15. Now, this is an oldie, but a goodie, yielding 22%, positive NAV return on the quarter, 6%, and a really low volatility, not too risky, approximately market type volatility at a 15. That's about as volatility as maybe the NASDAQ is the Qs, which are pretty volatile, but not near as volatile as some other things that we talk about. All right, number 14 is Chippy, yielding 35%. We'll just round that up. quarterly NAV return of 6.45%, and a volatility of 24. So Chippy's volatility is very similar to K-Gold's volatility. You could expect them to have about the same amount of risk and the same amount of movement up and down. Volatility is good on the way up, right? You want a volatile stock that's when it's going up, but then when it's going down, it hurts you. It's like anything else. No free lunch, no free money, no free anything. You have to work for it. GDXY number 13. I have this one myself, quite a bit of it. This is the one I'm thinking about selling to get K-Gold. And the reason is because the volatility is getting to me. This thing's a 38 vol, right? The SPY's traditionally 12 or 13. So you could get, it's 3 times as volatile as the SPY. You know, I mean, it's done well for me, but it's the ups and downs are starting to get to me. I think that something like K-Gold might work better for me. Now, I'm not going to be making as much yield. There's no free money though, right? I mean, so of course that would make sense. I'm not making as much yield. I'm taking less risk. All right, TSLW. Now this one is part of the W series, which is the weekly series from Round Hill. This one is not truly an option fund. It's a different kind of fund. They use swaps, but it's also an income fund, and it has similar mechanisms and similar risk and reward to the option funds. So it's, and it pays weekly, and a lot of people like it. So I think it's fair to have it in here, but these guys don't even really sell covered calls. They do something called swaps with other institutions, and the swap pays the yield for them. It's related, but not the same. All right. That's TSLW. Number 11 is IAUI. Wow. All right. So this one, yielding 12, quarterly NAV return of 10% positive. TSLW is up 12% on NAV. That excludes the divvy. I mean, that's really good. Maybe IAUI would work for me also if I sold GDXY, because it is also based on gold. It has less volatility. Because my point is, even if I sell GDXY, I still want exposure to that part of the economy. So IAUI could make a good alternative for me as well if I want something less volatile. And IAUI compared to K-Gold yields about 50% more. K-Gold only yielded 9. This one yields 12. So it's actually 33% more about. All right. Number 10, AMDY. I have a little bit of this one. Now this thing is volatile as all get out. A 68 vol. I mean, it's going to be a bumpy ride, but it's been bumpy in the right direction lately. NAV's up 12% on the quarter, yield 61%. At this pace, that's a triple-digit annualized yield, right? Because 12 times 4 is 12 and a quarter times 4. It's 49, right? So 49 plus 61 is 100%. Is that 100% or no? 110%. That'll work. That would work. Come on, AMDY. Let's keep it up. Let's keep this bull market going. All right. XYLG. Okay, now this one is super safe. It's from Global X. A lot of people aren't, big on these. They do something interesting. They only write options on half the portfolio. So they usually do pretty well on upside. This one has an asterisk because they paid a special dividend last year. This one typically yields 6% because they only write options on half the portfolio. But it's a good fund. It's a little bit deceptive that it's on this list. It probably wouldn't be if we took off the special dividend. But but over the past year, this has been the 9th best fund for people that had it. I mean, the special dividend did happen, so we're looking at it. All right. Number 8. Tesla. Okay, this is a monster yield, 107% yield and positive NAV return. Wow. Think about that. If at this pace continues, which it won't, this would be 20% NAV return and 100% yield. So what's 20 plus 107? 127. I mean, it may. If anyone could do that kind of stuff, it could be Tesla or Tesla. All right, number 7. GUI. Okay, this is based on Google, and this is yielding 42.97%. It's up nearly 8% on the quarter and still yielding 42%. Volatility is at 25, so it's, that's reasonable. Not as high as Tesla's volatility, right? Just depends on what you're looking for. We have a lot of good choices. There's like 134 funds on this list right now. All right, GLDI. Well, maybe this one would work also for my diversification. For if I sell GDXY and looking for other gold-based assets, this one might be a nice choice. I mean, it's volatility's about 50% less than the market, so it should go up and down less than the SPY. I like that. I don't like the real volatile stocks. And it's yielding nearly 14%, positive NAV return on the quarter. I mean, heck, if this continues, it's 28 plus 13, whatever that is, 41% about an annualized yield. Now, last year, we can look at the last calendar year, and they made 22% total return. So it's not out of the realm of possibility they might make 40%. We need gold to keep rallying, though, for that to happen. These things are very dependent on the price of the underlying. I made a video on Alti yesterday and showed the relationship between Alti and the NASDAQ and the Qs. And I thought it was an interesting video, but I was trying to show the degree to which they're linked. All right. Number 5 is Goop. This is based on Google. It's paying, we'll call that 15%. We'll give them the extra 7 basis points, right? So 15% yield and a 20% NAV return. I mean, has anything else yielded 20% NAV this quarter? I think that's our NAV champion right now at this point in the show. That is our NAV champion. Now, this is from Curve, and that's kind of Curve's brand, is to catch a lot of NAV return, even if it means maybe they pay a little bit less yield. The other closest Google fund is GUI from YieldMax. Well, their brand's the opposite. Their brand is, well, we're going to do better on yield, but it's going to have to come at the cost of something, and it might come at the cost of total return. So GUI and Goop, let's make this our first battle royale. Let's just test these since inception instead of just going back a quarter. I think over a quarter, Goop is going to have done better because it's higher on the list. But let's go a year ago. Let's look at the last year of these two. Okay, so here we have it. So it's really close. If you're reinvesting dividends, you did a little bit better in Goop, but, well, no, I'm sorry. You did a little better in Goop without reinvesting dividends. And if you reinvested dividends, it's roughly the same, 42% to 42%. Goop did a little bit better compounding when you reinvest the dividends, but 30% to 37%. These are both obviously good, but you'd have to give this round to Goop. I mean, you'd have to give that round to Goop. Sorry, YieldMax. Maybe you'll win the next one. All right, number 4. TLTW. Now, this is crazy. I was looking at this a little while ago when I was preparing for this show. This is based on the bond market. Okay, bonds are ultra boring as an underlying. Bonds have a lot of stability compared to the SPY. And sure enough, this is a fund that sells covered calls on the bonds. And even with the addition of covered calls, it's only a 6 vol, half as volatile as the SPY. That's a really low volatility. That's super low. It's paying a 15.8% yield, and it has positive NAV return on the quarter. I mean, at this rate, it's going to make about 35% total return for a year. I don't think that rate will continue, but that would be awesome out of a bond investment. To get this kind of yield with this low of volatility is actually pretty good. This thing's had a good quarter for sure. Let's just look at it. Let's look at TLTW and let's compare it to Alti. I compare everything to Alti. Alti's my favorite fund. You can see Alti beat it, and of course Alti's a really good fund. It's also really risky, but sure enough, in this bull market, it beat it. But look at the rally that TLTW has done. It went from basically unchanged a few months ago, or 6 months ago, and it's up like 7 or 8% in the past 6 months. That's a lot for this safe of an investment. And by the safety, you can kind of see that in the return. The black line is TLTW. Well, look in the April pullback, how much it was down. It dropped from 10 grand to, it looks like 9,600. It was down 4%. That's that low volatility working for you. Now, the other side is it's not going to go up as fast, and that's why Alti's beating it. Alti has a lot higher volatility. The market's been bullish, but I think those are both doing well. And I really think if you factored in the low volatility, I mean, TLTW looks pretty attractive when you consider the volatility. And I actually have a little TLTW. Not enough of it though, but all right. So, and I bought it back in April. I was looking for stuff that would be safe when the market sold off, and I've just kept a little bit of it, but it did. It gave me safety. Okay, so we've already looked at that. Let's check out number 3, iGold. Gosh darn it, my Sooners are already down 3-0. I guess Ole Miss kicked a field goal. I'm watching the game at the same time. Even though I live in Austin, I'm a Sooner, but anyway, it's a complex relationship. iGold, yielding 15%, and this would also make a good alternative to GDXY. Plenty of good alternatives. Now, this isn't as safe as some of them. It's kind of mid-pack, but it's paying a little bit bigger yield. And for the quarter, the NAV's up 15%. That's insane. All right, let's see who's next. TS2 or TSII. I call that TS2 because I'm copying off of Miss Roundhill. She says TS2, and I always thought it sounded cool. All right, TS2, 40% yield and a 23 positive % NAV return. At that rate, they'd make 100 a year. Remember the formula, it's going to be this plus this equals total return. This thing's on pace to make 140% total return. It hasn't been around long enough to see what it made last year. It's a new one. This is from Rex, and it's a good one. What do you guys think is number 1? I know what it is. I bet you it's TSLP from Curve, because Curve is really good company. All of these are really good, or a lot of these are really good companies. I think the Mount Rushmore of the high yield space is Curve, Yield Max, Roundhill, Curve, Yield Max, Roundhill, and Rex and Granite shares. Right? Did I miss any? I think that's the Mount Rushmore. I think those are all, they all could work depending on your circumstances. All right. TSLP is the winner, and I thought it would. This is for Curve. So Curve's knowing to do a little bit better on NAV return and maybe not quite as good on yield. So let's just run TSLP against TS2 over the past, since inception and see and just kind of compare them with each other. All right, so here we have it. This goes back to since inception on the Rex fund, which is the TS2, TSII, whatever you want to call it. They were incepted on June 4th. So it hasn't been around a real long time. The man gold has just been Tesla has been ripping higher, and these are both benefiting from it. TS2 actually has better total return if you're a Rex holder. The reason TSLP probably one is due to the volatility. TSLP is probably a lot safer. TSLP's volatility is 35, and TS2's volatility is 44. That neither of them are particularly safe, but TSLP is about 33% less volatile, and it makes a difference. It makes a difference. All right, well, I hope you guys like that. So that's the short-term Maxfactor. So let's go to the long-term Maxfactor. All right, now this won't have all the funds in it because you have to have been around a year to be considered. So this only has about half the funds. A lot of these are new. So the short-term max factor is the max factor. TSLP is the champion. I show the long-term also just for, just to look at another perspective. And also it's the same formula, but it looks at over the past year. So you get a better idea of the risk and reward over a longer time frame. So I think this should be good. Let's check it out. All right, number 20 is QQQX. Wow, look at this. Yielding 8%. NAV's up 5%. Super non-volatile. It's only a 10 on volatility. So that's really good. And it has a 1-year total return of 18%. I mean, it pays a 7% yield. I mean, that's good. All right. InFly, based on Netflix from YieldMax, has done poorly this quarter, but this looks longer than the quarter. Over the past year, it's done really well. It has a 29 volatility. All right. Triple QI. Now, I really like this one, and I gave this one as an alternative for people that don't like Alti yesterday. I gave out 4 or 5 of these ones that are really steady, but they're going to pay a lower yield. That's kind of how the steadiness happens. But sure enough, Triple QI has a 12 vol, so it's you expect it to go up and down about as much as the SPY. Yields 13.49%. The SPY only yields about 1.5%. So you can see the advantage to Triple QI. Quarterly NAV returns up 3%, and the 1-year total return is up 20%. So that's really good. Let's just run this against, though. Let's run Triple QI against Triple Qs. Now that Triple Qs are the parent asset. Total return for the year of Triple QI was about 20. I bet the total return for the year on the Qs was a little bit more. Well, but I just wanted to see. Sure enough, the total return on the Qs itself was 25%. Triple QI, but the Qs themselves pay less than a 1% dividend. So Triple QI is a decent use case if you need yield and you don't want a whole lot of volatility. That's why I gave it as an alternative to Alti. With Alti, you're going to get a lot of volatility. And you're also going to get a lot more yield, right? All right. Number 17, Clip, yielding 32%. Quarterly NAV isn't that great at 1%, but for the year, it's up 20%. Decent volatility. Number 16, CLM. This is a closed-end fund from Cornerstone that a lot of people love, and this thing's doing well. It made 24% 1-year total return. The Qs, the NASDAQ, made 25%. So this baby cub has the same total return as the NASDAQ and is paying a 17% yield along the way, and the volatility's commensurate with something like the SPY. With the overall market, it has market volatility. That is a good fund in retirement. I mean, that one passes the eye test. I wish it had a little bit better NAV return this quarter, but that one definitely passes the eye test. All right, speaking of passing the eye test, I mean, this is the full package. Now, this is YMAG based on the Mag 7 from YieldMax. Now it's a little volatile. It's a 16, so about as volatile as the NASDAQ. And that would make sense because these funds are all NASDAQ funds. What is it? NVIDIA, Google, Apple. I mean, yeah. So it makes sense it's about as volatile as NASDAQ. But NASDAQ doesn't yield 50%. Now, the 1-year total return lagged the NASDAQ. NASDAQ yielded about 25% on a 1-year total return. But this could work if you need the yield and don't want too much volatility. That could also be a good alternative to Alti. I don't think I put that one on there. That one could be a decent alternative to Alti, and really so could K Triple Q. Now you're going to sacrifice a lot of yield, but this has very low volatility, market volatility, great NAV return for the quarter, up 7% for the quarter. Heck yeah, we'll take that with the low volatility. I'll take that. All right, Maxi. This is based on Bitcoin, yielding 35%. Now Bitcoin's got beat up this quarter. It's why my favorite fund isn't on the list right now. They have a lot of Bitcoin exposure, but Bitcoin has really taken it on the chin lately. But if you look back over the past year, I mean, 45% total return. Now, if you get into this, just know it's a 65 on volatility. This volatility is roughly equivalent to the VIX for you guys that are market traders. You guys know When the VIX is average or low, it's 12, 15, 16, something like that, 17. That's kind of the average for the VIX. When the VIX goes up to 60, what is that happened? The VIX hit, I think, got in the 50s in April, but it gets up in the 60s whenever the market is super volatile and generally when the market's selling off. So this is going to be a rough ride. Lots of ups and lots of downs. All right. Number 12, GLDI. So this is a gold-based one, and we're looking at a year. This one was on the other list too. Look at this, an 8 volatility. That's really good. This is probably the safest gold fund, yielding 13%. That's really good. All right, TSMY, based on Taiwan Semiconductor, also a yield max fund, down on the quarter, but up 23% on the year. About twice as volatile as the broader market. So be cautious, but you're trading that volatility for a pretty high yield at 59.85. SLVO, this was on the other list also. Decent volatility, decent yield, great quarterly NAV return, great yearly NAV return. This one also passes the eye test. It's balanced, it's good, it does what it's supposed to. Those are some good metrics. Now this one's good, but the 68 volatility, AMD, it's a yield max fund, the 68 volatility kind of scares me off of this one, but it's done really well this quarter. It's up 12% on the quarter and 13% on the year. All right, number 8, GUI. We've already looked at this one. Yielding has a volatility of about 25, yielding 43%. NAV's up on the quarter and on the year, or NAV's up on the quarter and the total return is up on the year. Number 7, Babo, yielding 71%, super volatile. Done well this quarter, done well this year. GDXY, we saw this on the other one. This is also pretty dang volatile, about 3 times market volatility, paying about a 48% yield. It's based on golden miners. It's up 7% this quarter. It was up a lot more before a few days ago when GDX, the parent asset, started selling off. All right, number 5, iGold. Okay, this is interesting. We got the gold ones up here, so we can compare these two right with each other. GDXY yields, 3 times as much, but it also has, it looks like it has about twice the volatility. So anyway, iGold is a little bit ahead on the metric because my metric figures the volatility into the equation. That's part of the equation. In other words, other things being equal, you have 2 funds that yield 20% and have 20% total return, but one of them is a 50 vol, meaning it's going to go like this, and one of them is a 10 vol. The 10 vol is more valuable for allocating to a portfolio. Number 4 is Goop. All right, this is based on Google, yielding 15%, 1 year total return of 35%, decent volatility, 21's not too high. Google's pretty steady. It's a mature company. It's not going to be as volatile as like Tesla or, Tesla's based on Tesla. So the volatility is 46 on this baby. 1 year total return of 32, but you got all that yield with Tesla. That's good to see. Number 2 is TSLP. We've seen this on the other one. This is from Curve, 35 volatility, but it's also making a 35% total return. It's also yielding around the same. This one is also passing the eye test. Because you have everything. You have low vol relative to other ones that do the same thing. High yield, high total return, high quarterly NAV return. I can't imagine one being better than this, but if there is one better than this, I think I know what it is. Palti. All right, Palti's number 1 over the past year. And you may say, well, why wasn't this on the short-term list? Well, the short-term list just measures the last quarter. For the last quarter, this thing's kind of struggled, being down 9%. Now, it's still doing well because it's paying an 89% yield, but not near as well as it's doing over the past year time frame. Over the past year, this thing's up 193% total return, and it's paying an 89% yield. we can take the difference between these two numbers, and it's 34. And that is the NAV return. Because remember, total return equals yield plus total return, 123 equals yield plus NAV return. We don't know the NAV return, but we could solve for X. It's 34% over the past year. So that's really good. It's NAV's up 34% over the past year, but down 9% this last quarter. So, all right. So that's the list. I hope your favorite fund made it. So now let's reset this and let's go to the complete. Let's go to the complete table. And I'm going to go to my favorite fund, Alti. I mean, blocks and WPay. I mean, I have 3 or 4 blocks, Alti, WPay, GPTY, but Alti's the one that I think's Alti and blocks are the ones that I'm really obsessed with. So let's go look at Alti. Let's just go see why I didn't make the list. And I can tell you why, because it's been doing poorly lately. There it is. Alti. Now that's, it's a yield champion at 123%. Unfortunately, the NAV's down nearly 20% just this quarter. So, it still has a positive return for the quarter, of course, because it's paying such a high yield. Other things being equal, we'd rather see that NAV not be down quite so much. And a few weeks ago, this was on the list and the NAV was down like 5%. But with the NAV down like 5% and a total return of, in this area, there's plenty left over, for the investor. But as the NAV's pulled back, this thing has too. Has a 21 yield, which is actually pretty reasonable considering the funds it invest in. The reason that total return or the volatility is kind of relatively low is because they use a caller strategy, and a caller strategy sells calls and uses the money from the sold calls to buy puts. Well, when you buy a put, you cut off large swaths of the downside. So it dampens volatility to do that strategy. Now, my second favorite fund, or tied for first, may be blocks. Let's compare Alti to blocks. Let's go look at blocks. Now, blocks is going to have a lot more volatility because they do a different option structure. Their option structure doesn't cut off large swaths of the downside. They have a totally different structure. Unfortunately, Alti's option structure also cuts off large swaths of the upside. Well, this thing doesn't cut off any upside, but also it doesn't help you much on the downside. So blocks is going to be more volatile and, definitely a more bumpy ride getting there than Alti, or at least it has been over the past year. Let's compare blocks and Alti since inception. I bet blocks is beating it. In fact, I know it is, but let's just see what's going on. All right. Alti's up 12% over the total return over the same time frame. Blocks is up 49%. Maybe I need to switch and make my favorite fund blocks. And I do like blocks, but I put a large premium on safety. I put a large premium on being able to sleep at night. So, but you don't have to invest in just one fund. I have a mix of both of these. So when you average this in with some other funds, Alti will bring my average yield up because it's yielding triple digits, or at least 80, 90 every week, and sometimes more. Whereas blocks will bring my NAV return up. Blocks' NAV return has gone from 19 to 25 over the same time frame. Alti's did all right. It went from 618 to 504. That's not too bad. It's not like they lost half its value or anything, but granted, that's only over a third of a year. If you roll that forward over a full year, it would lose half its value. And that's what my video yesterday was about. If you haven't seen it, but go watch it. But in an average year, you can count on Alti to lose 50, 60% of its NAV value in an average year for the NASDAQ. Now, if the NASDAQ's way up, Alti will do much better. But in an average year where the NASDAQ's up 10, 15, 20, 25, 30%, Alti will lose somewhere between 50 and 65% of its NAV value. Now, the thing is that seems terrible, but it's also paying a yield that's more than 90% oftentimes. Remember, total return equals NAV return plus dividend return. So even though the NAV return is negative, if the dividend return is a lot more positive, you could still have a good total return and still compound your money. All right, guys. Well, that's it for this week. I really appreciate you being here. I'm going to go watch this football game. My Sooners are behind 10-3 right now. So hopefully we'll find a way to come back and beat Ole Miss, beat the Running Rebels. All right, guys. Thank you so much. And you have a wonderful afternoon.